Okay, so in my last video, I discussed how I discussed why asset prices, specifically housing prices, rose so much after during the COVID pandemic, and how that was linked to monetary policy, global monetary policy, and I kind of explained how monetary policy um, in Australia affected house prices um, and affected all assets. Today, I want to talk about something else that happened during COVID, and that's the collapse of the Reserve Bank's yield curve control. Not collapse, but basically, the government at the time was issuing a lot of debt during COVID, and in order to keep the cost of that debt low, the RBA had a policy of yield curve control. This is where they keep effectively the interest rate on the debt that the government is issuing. They try to pin it or have a something called a peg. This is where you try to hold the interest rate down at a certain percent, and they tried to keep this down to keep borrowing costs low, but in the end, they weren't able to hold this peg. Right? So I'll discuss that today, and basically, why weren't they able to hold this peg? Well, that's to do with inflation and stuff, but there were a lot of people shorting the Australian government bond. They thought it was, I guess, that what papers will say is that they thought it was mispriced. Um, when you have a peg, whenever a central bank commits to a peg, it puts them in a difficult position, and traders, investment funds, hedge funds, they can take advantage of this, and that is what they did. So we're going to discuss the mechanics of that today, and discuss its impact, its consequences, and hopefully you'll understand a little bit about how our monetary system works. So before we jump into that, let's just explain what a short is, because it is kind of a complicated idea. Say if I have this hourglass and I want to sell this hourglass. I think the hourglass is going to profit, right? This is my friend's hourglass. I don't own this. And I tell him, look, how much did you buy this hourglass for? And he tells me I bought it for $10 this year. And I tell him, look, I reckon this hourglass is going to cost you, you can get one of these for $5 next year. So let me borrow this from you. Let me sell it to, sell it to someone today. And let me buy it back at, $5, and then I'll give it back to you. So we'll, make a $5 spread off the fact that this instrument has fallen down in price, and then you will be in the same position where you started, where you have your hourglass returned to you. So that's like a simplified way of thinking about shorting, but you're kind of borrowing something to sell in order to make profit off of it. Okay, so that's shorting. Now that's hourglasses are simple and all, but how do you short a government bond, right? How do you short a government bond? How do you make money off that? And I will explain to you how. So if we reflect back to COVID, here in Australia, or governments all around the world, they had to have fiscal stimulus packages, right? Giving money to those who needed it during this crisis. And in Australia, we had something called Job Seeker and JobKeeper. And there were some other fiscal programs. This was like more just marketing fluff, but basically fiscal policy, fiscal stimulus. Now, to fund fiscal stimulus, you can fund it, let's say, through two ways, two mechanisms. You have taxes, so you can collect taxes from citizens, I guess people living in the country. And then if you cannot raise enough money through taxes, you can also always raise debt. When governments raise debt, they do it through instruments called bonds. And during 2020, given the fact that COVID was an unplanned, uh, it was a crisis that kind of came out of nowhere. Governments had to issue a lot of debt in order to backstop their countries. And we'll discuss this in another video, but bonds specifically are basically the basis of our financial system, I could say. Or, I mean, definitely the US Treasury, the US Treasury is the reserve instrument of the world, or it is the foundation of our global monetary system. And the fact that the US Treasury is not doing as well as it used to has a lot to do with why the world is kind of a bit messed up today. And it will be interesting to see what kind of monetary system we evolve to. Things are definitely going to change over the next 10 to 20 years. And it will be interesting to see what develops over time. But getting back to our point, bonds are how governments issue debt. So how can I sell a bond? How can I get money into the government? We'll say if I'm the government, I'm the Australian government, and I'm like, I need $1 billion. Say maybe I need a bit more than that, 100 billion, to lend out in job seeker payments. What I will do is I will go to an organization basically in the government as well called the Australian Office of Financial Management. They are responsible for holding bond auctions. So these bonds that the government needs to issue, this 100 billion, they will go. The Australian Office of Financial Management will basically hold something called an auction. And at that auction are invited some big boys. They're called like dealers. Dealer 1, dealer 2. There'll be a few of them. And basically, it is their job. They are the government will first sell the bonds to the primary dealers at an auction, right? And these guys, I guess you could call them market makers. So they will buy bonds. They're big institutional players, and they will take the bonds and then sell it off to, different investors. And this will make like the secondary market. So you've got pension funds. You might have other investment funds. It's like macro funds, I don't know, all types of funds basically, maybe sovereign wealth funds, anyone that wants to buy Australian government bonds, anyone that wants to lend to the Australian government. All right, so when they do this, obviously these guys will provide some money up front. Say if it's like a $10 billion bond, they'll provide that 10 billion, and then over time, the government will pay interest on those bonds. They're called coupons, and they, the dealer is not involved at this point anymore, but the idea is that the government will pay periodic coupons to the bondholder. Okay? So that's how debt is issued. And one thing that you should notice is that these bonds here can be bought and sold between each of these parties, right? So you might have a pension fund that wants to offload some of its bonds, and it might sell it to, I don't know, a hedge fund, right? Just for example. These bonds can move between different parties. People would buy and sell it. And obviously, with any market where you are buying and selling things, if there's more demand, that's going to drive the price up. If there's less demand, that's going to drive the price down. Right? So you can, buy and sell these instruments, and the volume of buying and selling will affect the price of the bond. Okay, and that's important given the fact that it will help you understand why and how we short the bond. So before we jump into that, let's just quickly go over how the mechanics of a bond and what a yield is on a bond, right? So if you think about interest, the government has to pay some interest. The bonds, every bond has a certain yield at a given point in time, depending on its price. And typically you'll see this thing all the time, but it's called a yield curve, time, and you might have 1 year, 5 year, 10 years. And this is how the bond is priced. So obviously things that are happening more closely in the future, there's less time, so you can get an idea of what could happen, what couldn't happen. Like say if you want like $500 from me and you say, I'll pay it back by tomorrow, I'd be pretty happy with that. Whereas if you say, I'll give me $500, I pay you back in 10 years, it's I very much doubt that you'll be able to pay that money back for me. So you could think about bonds in that way as well, right? Like investors will be trying to price, the risk of the bond, the yield of the bond. So the yield of a bond is inversely proportional to the price of the bond. So when the yield goes up, then the price will go down, right? And bonds can be, as you see here, bonds can be traded, like released on different timescales. Right? So this is a very quick rundown of how bonds work. Important thing to remember is that yield and price are inversely related. Right? So now we'll go back to, so now I will explain how this whole shorting works, right? So as we discussed before, the government, you have, let's just set the agency, put it there. They will sell the bonds off, right? They will send the bonds off. You've got your dealers here that are responsible, the middle managers. And then you'll have a pension fund, some other fund, right? Different people where the bond is. Now, the RBA said that they wanted to set the interest rate of this bond at 0.1%, right? That's on a 3-year bond. And this would have been, I believe, the 2024 bond, right? So from if we do 2021 to 2024, they were trying to set the interest rate of that to 0.1%. And they did this because, they wanted to keep the cost of borrowing down for the government. It also has a lot to do with how other things are priced. But in this specific scenario, they just want to provide enough credit, enough liquidity to the country whilst it's in this crisis. The issue with the year 2021, I think, is that investors were starting to price in inflation expectations, and they basically believed that this wasn't the true price of the bond, right? Not true cost. They thought that the yield here, it should have been higher. They thought that this 0.1% was not correct, and that is the shorts position, right? So the shorts believe that this is not priced correctly, And why do they believe that? Because the RBA is kind of, um, uh, you could say, engineering that price to a certain respect. So as we discussed, so the RBA, in order to keep the price at 0.1%, and remember we said that price and yield are inversely related. So you want to keep this percentage number down at 0.1%. That means that you want to keep the yield from moving up. That means that you're going to keep the price of the bond high. How do you keep the price of the bond high? By buying any extra bonds that hit the market. So the RBA, when they commit to this 0.1%, they are saying that we will buy excess bonds. There will be basically a reserve buyer of sorts, right? They will continue, if lots of people are not buying the bond, if there's not demand for the bond, that means the bond yield should be rising. They will come in and they will buy up enough of the bond that the price of the bond remains at 0.1%, right? So and that's basically what yield curve control is, right? And it's very problematic, as you will see. But the RBA has basically committed themselves to this, and the shorts are now going to test this. The shorts test this. They're going to test the RBA and see whether they will hold on or commit to this target. So how do they do that? Right? So say if I've got a pension fund here. So now we explain how the short happens. So say if I have a pension fund here, right? And it's got an Australian bond, right? 3-year on its balance sheet. And I'm a hedge fund. And I'm like, I would like to short this bond. The price of this bond, say the price is like $100, right? I'm just using an arbitrary number just to make it simple. Say if I think this is $100, and obviously that the price correlates to, like, let's say we're trying to keep it at 0.1%. And I think, that's wrong. So how do I short this bond? How do I start selling something that I don't earn? This is where people like Wall Street come in. So you've got JP Morgan. I always use that example, but investment banks here will act as a broker. They will basically connect the two parties like this, and the hedge fund will essentially use something called a repo, or a repurchase agreement. So what the hedge fund will do is they will provide, let's say like $100 cash, and then the pension fund will take, they'll take this the pension fund will take the pension fund will take this Aussie bond, and they will give it to the hedge fund, and then obviously the hedge fund that had $100 cash will exchange that to here, right? So they do a bit of a swap. Aussie bond, and he gives $100. And a repurchase agreement basically means that after a given time period, these will be swapped, or it will be purchased back. So the pension fund will purchase this back after maybe like 1 month or something. And then when they purchase this back, the $100 will go back to you. So we're basically kind of literally borrowing it from, I'm borrowing it from you. So once the hedge fund has the bond, then they can just sell it, right? They can just sell this thing, and that's what they did. So they continue to And they continue to do this with as many bonds as they can. So they try to do this at different points in time, and the central bank is able to defend its peg at certain points in time. But what happens is, if we have the hedge funds here, right? So hedge fund, and then we have pension funds and other people that might have the bond. So there's if I get so the bond is moving to here, and then the hedge fund is moving cash into the person that it's buying it from, and then the hedge fund will basically dump this bond, sell, and the central bank, remember, or the RBA, promises that will buy to keep cost at 0.1%, right? So the RBA at one point, at certain over time, is just buying up all the bonds. All the bonds are basically returning back to the RBA. And what this does is it kind of defeats the purpose of having a floating market, or how our kind of how our markets, how finance and money works today. If the RBA is just buying most of the bonds, then it actually it means that there's like no real demand for your debt, right? No one really only you want to hold your debt. And I think at one point about the RBA is holding about 60% of the bonds that the government was releasing. Right? So this creates problems onto itself. The RBA first has said that we're going to keep rates at 0.1%, but if because they've committed themselves to this, that also means that they have committed to themselves to buying all the bonds necessary to keep the price at this amount. And hedge funds here are going to test them. So what once they buy 60%, certain things happen. So you will remember that in order to facilitate this transaction, we do something called a repo, right? And when this happens, the hedge fund that brings the cash here, this cash, here, it actually attracts interest during normal times, right? If this 60% isn't reached, the hedge fund can actually earn interest from this cash. But in a situation like this, where so many people might be trying to short the bond or getting their hands on the bond, they're trying to push the bond from that balance sheet to this balance sheet. This repo, or the interest rate, or the repo rate, as it's called, it can go special, basically. What does that mean? That means that basically the hedge fund will have to pay interest in order to borrow the bond. So they not only have to provide the collateral, but they have to pay the interest on that. And that creates problems where the bond, it loses its liquidity, right? If you have to pay to get an instrument, then this instrument cannot move around between different parties. It cannot function correctly. So that's one problem that the RBA ran into. And then they had to, they have this facility called a special lending, like a special lending facility, or a place where they can lend bonds out of. And what ended up happening is people who are trying to short the Australian bond just start borrowing it from this SLV. They start borrowing it from here. So they're borrowing from so they want to get their hands onto bonds, onto Australian government bonds, and then just sell them again and continuously short them. And when you couldn't even get it from people like pension funds, other funds that are bondholders, if the RBA is a major bondholder, they were trying to get it from them as well in order to short. So then what the RBA did is they put fees up on this facility in order to reduce the amount of people, and basically this fee acts as like an interest, like a cost of borrowing. So they put this, and in the end, um, the peg ended up breaking. I think the RBA, inflation was kind of becoming a problem at this point. This would have been, so the peg finally broke in 2021, I believe late, maybe like October to November, sometime around here. And all the hedge funds, all the shorts, all they needed to do was continuously borrow and short the instrument. And once the RBA got themselves into this situation, I think it just got a bit went all a bit downhill from there. But yeah, so they short. I think in October they start to realize that this is not going to work, and once you're basically buying up all of the debt that the government is releasing, it's almost like you really are printing your own money at that point. I guess even though people will say COVID, you print money, it's the debt is still being held by other people, right? There's still someone willing to, I guess lend you that money, but in this case here, it's kind of no one. So the shorts just need to hold on, and they just need to keep continuously short, and the RBA at one point will basically stop buying bonds. They'll just stop. The RBA will basically, they'll just stop buying the bonds, right? And that's what they did. And the minute that happened, the interest rate, or the yield, if we go back to that idea, the yield jumped up straight away, maybe about like 0.5%. We won't say basis points, somewhere around there, like 0 to 1%. It kind of jumped up. And the minute it jumped up, obviously when the yield jumps up, then the price it goes back down, right? So yield and price are inverted. So the hedge funds here, they're selling these bonds. They're selling these bonds to the RBA, let's say, and they're selling it at $100. Let's just use a nice easy figure. And then once the yield drops, once the yield goes up, the price of the bond goes down. Say it goes down to $90, then they can buy this bond back up, and then they make that $10 amount. And once they buy the bond, they can return it to this guy, or you can even do a cash settlement. So say in the scenario where you can't get the bond back, because what the RBA did was, if the RBA kind of owns most of this, they just hold it to maturity, right? So it will just set on the Reserve Bank's balance sheet until until the bond is finished. And in that case, if the hedge fund can't get their hands on a bond to close out this trade, or to return it to the pension fund, what they'll do is they can just settle in cash. So even if instead of providing the physical bond back to you, I can just say, hey, look, I'll just give you this $90, right? And that's good enough, because that's the price that the bond would be anyway today. So they can get the bond, or they can just get how much money the bond is worth today. And they end up in the same position, right? Because if they would have held that bond, then it would have been this price anyway. And the hedge funds are able to, just make a bit of money by trading this instrument. Now, well, that's all well and good, that's all just like, finance. How does that affect the Australian people, or how does that affect the domestic economy? Well, in hindsight, I think it affects what it does, it affects the credibility of the central bank. Central bank credibility, I would say, is the main thing. Central ability. Um, you've committed yourself to this target, and the central bank at the time was saying that we're going to keep rates at 0.1%, and then suddenly you have to you can't afford to buy these bonds, and then what happens is that when inflation starts to kind of cause problems, the bonds that sit on the bonds that the central bank has bought, they're only earning an interest rate of 0.1%. So there's only 0.1% on the bond coming in. Whereas now that the central bank has to increase interest rates, they might have to pay interest rates out at, like, I don't know, say like hypothetically 0.5%. So they're in the situation where they're making a loss, right? I don't think in the long term it was too bad. I think there are other problems, but and it's just the 3-year bond that was mostly affected for a given time period. But I guess it's still probably a bit humiliating to have to go through. So, and this has happened a lot of times. I mean, the Bank of England, their dollar was went through something like this. You have the Asian crisis. You have a lot of cases like this. Where institutions are shorted. Another thing that it affects is the cost of other instruments. So the 3-year, if the government's cost of borrowing was 0.1%, then other instruments like fixed home loans, fixed rate home loans, they will be priced off, other fixed income instruments like bonds. Right? So if I can borrow from the Australian government at 0.1% over 3 years, then if I'm borrowing from if I'm lending to the Australian housing market, if I'm lending to the Australian government at 0.1% over 3 years, then if I'm lending to the Australian housing market, which are private individuals, then I will probably want to ask for a bit more than 0.1%. So if this goes up, then this generally goes up, but I wouldn't say that, that's like, this is just how instruments are priced. But yeah, that's kind of the fallout of it, I guess. And now 3 years on, the guy that was in charge of the central bank at the time, he's not there anymore. So maybe, I don't know if this had something to do with it, but yeah, that is how the Australia's central bank was shorted during COVID, and yield curve control. So I don't believe other central banks attempted this during COVID. Maybe Australia's central bank, or the governor, Philip Lowe, maybe he thought that Australia's bond market is not something that people would want to come after. But I guess where a profit is to be had, a profit will be made. So yeah, with the mechanics of this, I am leaving certain things out because even this I feel like was quite complicated. Generally, hedge funds will also will want to cover their short position, so they'll have a hedge against this short in case the short doesn't work out. There was a possibility that the RBA could hold this peg the whole way through, and if that had happened, then the shorts would have lost a lot of money. That meant the bond price wouldn't have fell that much at all, so they've got to buy this thing back. The worst case would be if the price went up. All right, so to cover that, what they'll do is they'll buy something else that will make money if that scenario is correct. And basically, they'll price it at such a way such that they'll have some spread of profit that they can keep for themselves. Little things like that. There's really a lot more going on when it comes to the central bank, but this is the crux of the idea. And again, I'm just hoping that I can give you a glimpse into how, when people talk about finance and Wall Street and um, you know banks, this is kind of what they do. It sounds complex, but when you break it down slowly, it's not too complicated. And the principal amounts are just humongous. Like, you're trading hundreds of millions to billions of dollars, right? And the financial economy, really, the financial economy has just been growing a lot more than the real economy, right? All of this stuff, all of these instruments and how they move and how wide the flow of cash is just getting wider. The principles are getting bigger. You have IPOs like that are, SpaceX IPO, 1 trillion, 2 trillion. I mean, how big can financial products, the financial aspect of our life become, right? I think that's the big thing that people are struggling with today. The only reason that people, the problem with housing markets is they've really fallen into this one, right? Houses are now also an instrument. They are just like something that you move around on a balance sheet. And again, it's a symptom of this bigger problem. But yeah, that is basically what happened during COVID 2020. Yeah. Okay, so in the next video, I will cover quantitative easing, how that works, and how that affects you.